Hello everyone and welcome to our channel. Today, we're going to explore a fascinating and crucial topic for understanding the evolution of financial markets. The weight of the top 5 stocks in the S&P 500 from 1965 to 2024. During this video, I'll present a dynamic chart that shows how this weight has changed over the years. The chart you'll see is generated from the data displayed on screen, with the sources listed at the bottom. Get ready for a journey through market history, where we'll see how major companies have shaped the index and why we're currently at a historic moment with an unprecedented weight of tech stocks. To put this into context, the S&P 500 is one of the world's most important indices. It comprises 500 of the largest companies in the United States and represents about 80% of the total market value of U.S. equities. However, within these 500 companies, there are 5 that typically lead the index and exert a disproportionate influence. Currently, these 5 companies are Apple. Known as one of the world's most influential tech companies, Apple has revolutionized how we interact with technology through products like the iPhone and Mac. Its market value is immense and constitutes a significant portion of the S&P 500. Microsoft, another tech giant that dominates the software and cloud computing sectors. Microsoft has been a market stalwart for decades and continues to innovate in areas like artificial intelligence and enterprise services. Amazon, initially an online bookstore, Amazon has become the king of e-commerce and a leader in cloud services through AWS. Its growth has been meteoric over the past 2 decades. Alphabet, the parent company of Google, Alphabet dominates the internet search and digital advertising markets. It is also investing in futuristic technologies like autonomous vehicles and artificial intelligence. Nvidia, though a more recent addition to the top 5, Nvidia has secured a leading position thanks to its dominance in graphics processing units, essential for artificial intelligence, gaming, and advanced computing. From 1965 to today, the top 5 stocks in the S&P 500 have changed significantly. Companies like General Electric, ExxonMobil, and AT&T used to lead the index in the past. However, with the rise of technology, giants like Apple and Microsoft have taken control. In the 70s and 80s, the top stocks represented a more moderate share of the index, reflecting a more diversified economy. It was in the 90s, during the dot-com boom, that the tech sector began to gain ground. Companies like Microsoft and Cisco Systems reached dominant positions. The chart we're showing illustrates how this weight has gradually increased, reaching a critical point in 2023 and 2024, when the top 5 stocks accounted for more than 30% of the index. This is a historic level that we hadn't seen before and raises serious questions about market concentration. It's important to note that today's tech stocks are highly overvalued. This means their market price doesn't necessarily reflect their intrinsic value but rather very optimistic expectations about their future growth. This type of overvaluation can lead to increased volatility and the risk of severe market corrections. When the top 5 stocks hold such a large weight in the index, any negative change in their performance can disproportionately impact the S&P 500. This situation affects not only investors in these stocks but also those investing in index funds that replicate the index. So, what does such high concentration imply? Historically, markets with high concentration in a few companies tend to be more vulnerable to sharp declines. For instance, during the dot-com bubble in the late 90s, the concentration in tech companies was one of the main reasons the market faced a severe correction. In the current case, the dominance of tech companies poses a dilemma. These firms are leaders in innovation and growth, but they also face regulatory risks, global competition, and economic changes that could impact their performance. Furthermore, this concentration can distort the market's perception. When indices like the S&P 500 show gains, it's possible these are primarily driven by just a few stocks, while the rest of the market may be struggling to keep up. A look at history reminds us that markets are not immune to abrupt changes. In the 60s and 70s, industrial and energy companies dominated the S&P 500. However, the oil crisis and technological changes reshaped the market. Similarly, in the 90s, the dot-com euphoria led to extreme concentration in tech stocks, only to collapse quickly with the bubble burst. These episodes underscore the importance of diversifying and not relying excessively on a single sector. While today's tech companies are more robust than the dot-coms of the 90s, they face their own challenges, from regulatory scrutiny to international competition. Looking ahead, the key question is whether this concentration will persist or if we will see a rotation into other sectors. In previous periods, we have seen sectors like energy, industrials, and financials gain prominence at different times. While the tech sector continues to lead, it may not be immune to economic cycles and shifts in investment preferences. Additionally, with the rise of sustainable investing and ESG initiatives, we may see greater diversification in major indices. This could reduce the current concentration and provide a more balanced outlook for investors. Another relevant factor is the potential advancement of disruptive new technologies that have yet to reach their full potential. Sectors like biotechnology, renewable energy, and AI applied to healthcare could emerge as leaders in the coming decades. Historically, such transformations have redistributed market weight and could do so again in the near future. Moreover, geopolitical trends and global economic shifts could alter the dynamics of the market. For example, emerging markets may play a more significant role in the coming years, influencing the weight of various sectors within the index. It's also worth noting the potential influence of demographic changes on market trends. As younger generations with different consumption habits and investment priorities gain purchasing power, companies in sectors like e-commerce, digital services, and sustainable energy could see increased demand. This demographic shift might reshape the landscape of the S&P 500 in ways we have yet to fully understand. Additionally, monetary policy changes and interest rate fluctuations will likely play a crucial role in shaping sector dynamics. Historically, periods of rising interest rates have favored financials and industrials, while low-rate environments have boosted tech and growth stocks. Keeping an eye on Federal Reserve policies could provide insights into potential market shifts. In conclusion, the history of the top 5 stocks weight in the S&P 500 shows us how the market has evolved from a more diversified economy to one concentrated in tech companies. This shift reflects economic and technological trends but also creates significant risks for investors. Today, we are at a critical juncture with historic highs in the weight of these stocks. This could lead to a market correction if expectations are not met. As investors, it's crucial to monitor these changes and consider diversification strategies to mitigate risks. If you found this analysis of S&P 500 concentration interesting, don't miss our next video, where we explore the fascinating rivalry between Inverse Kramer and Nancy Pelosi. Who performed better? Click on the video appearing on screen to find out. See you there.